All right, let's dive right in. Today we are going to do a masterclass on one of the most frustrating, soul-crushing experiences in all of trading, the fake breakout. We're going to investigate exactly why that picture-perfect trade so often turns into the perfect trap. You know the feeling, right? You've done all your homework, the chart looks absolutely pristine, and a key resistance level is just begging to be broken. You enter the trade, you're feeling good, feeling confident, and then bam! The market just violently snaps back, your profit evaporates, and your stop loss gets obliterated. And you're just left there staring at your screen thinking, what on earth just happened?
Well, you are definitely not alone, and let me tell you, it is not just bad luck. What if I told you that in today's markets, over 50% of all breakouts ultimately fail? Yeah, more than half. It's basically a coin flip. And this isn't some accident, it's a deliberate feature of how the market is structured. It's almost by design. And today we're going to pull back that curtain and see exactly how it works.
So let's treat this whole thing like an investigation. A fake breakout isn't some random market glitch. No, it's a carefully engineered event. It's a trap, and our mission today is to understand the anatomy of this trap so we can learn to sidestep it, or maybe even use it to our own advantage.
You know, in every good crime story, there are two main players. On one side, you've got the smart money. We're talking the big institutions. And on the other side, you've got the retail traders. That's you and me. And understanding why their goals are completely opposite is the key to cracking this whole thing wide open.
Okay, so here is the fundamental problem. Smart money, these big banks and funds, they're dealing with orders so huge they can't just click a buy button like we do. I mean, if you need to sell $1 billion of something, you need $1 billion worth of buyers on the other side of that trade. So where do they find all those buyers? Well, they have to create them. They engineer situations by targeting the very predictable behavior of traders just like us.
And that brings us to their number one weapon, a concept called inducement. The best way to think of it is just bait. It's a price move that's deliberately crafted to look like an obvious, can't-miss home run trade. It's specifically designed to trigger our FOMO, that fear of missing out, and trick us into flooding the market with orders, which they can then use to fill their own gigantic positions.
So where are they setting these traps? Well, they look for all the classic textbook patterns where we, the retail traders, tend to cluster our orders. These patterns, for them, they aren't barriers. They're treasure maps pointing to liquidity. An obvious resistance level, for example, is like a giant magnet. They know that just above that line sits a massive pool of buy-stop orders from breakout traders and stop-loss orders from people who are shorting. It is the perfect hunting ground.
But here's the good news. No matter how clever a hunter is, they always leave footprints. And smart money is no different. Their massive size means their actions create clues on the chart that they simply can't hide. So let's become detectives and look at the top 3 pieces of evidence they leave behind. So our very first clue comes from the breakout candle itself. The shape of that single candle can tell you pretty much everything you need to know about the war being fought between buyers and sellers at that critical level. You know, jumping into a trade before that candle is finished forming is one of the biggest, most expensive mistakes traders make, and it's driven by pure FOMO.
And this chart just illustrates the difference perfectly. A real, genuine breakout closes with a big, strong, full-bodied candle. It shows conviction. But a trap? Oh, a trap often forms a candle with a tiny little body and a long, menacing upper wick, what we call a pin bar or a shooting star. That long wick is basically a confession. It is screaming at you that buyers tried to push the price up, but they got absolutely slammed by sellers who have now taken complete control.
Okay, on to our second clue, which is just as powerful. If smart money is the hunter, then volume is their undeniable footprints in the snow. You just can't move billions of dollars around without making some noise. And that noise shows up directly on our charts as trading volume.
Now listen, this is absolutely crucial. A genuine, institutionally backed breakout must come with a massive spike in volume. It should be towering over the recent average. So if you see a price candle breaking a key level, but the volume bar for that candle is pathetic, if it's flat or even lower than average, that is a gigantic red flag. It's telling you the big players aren't in on this move. It's a ghost move.
Our final clue is a little more subtle. For this one, we need to look underneath the hood of the price action itself. We need to measure the hidden strength, or what we call momentum, that's driving the move. You know, price can lie to you sometimes, but momentum usually tells the truth.
This analogy is absolutely perfect for explaining something called momentum divergence. You can spot this using an indicator like the RSI, the Relative Strength Index. So imagine the price is making a new high. That's the car climbing the hill. But at the exact same time, you look down at your RSI indicator and it's making a lower high. That's the engine sputtering. It's a warning sign that even though the price is creeping higher, the actual buying power behind it is fading fast. It's a classic sign that the breakout is running on fumes.
Okay, so we've got our clues, we're looking at candlesticks, we're looking at volume, we're looking at momentum, but trying to juggle all of that in a live market can be overwhelming, right? It can lead to analysis paralysis. So to avoid that, we need a system, a simple mechanical checklist that guides our decisions and keeps our emotions on the sideline.
So here it is, a simple 4-step checklist. First, step 1, analyze the context. Zoom out. Is the market in a clear, strong trend? Because breakouts just have a much higher chance of working out when they're going with the flow. Step 2, identify the liquidity zones. Put on your smart money hat and ask, where are the obvious traps? Like a clean double top? Be extra careful in those areas. Step 3, confirm with evidence. This is where you check our 3 clues. Is the breakout candle strong? Is there a huge spike in volume? And is momentum on your side or is it diverging? You want to see all 3 line up. And finally, step 4, execute your plan. If all the evidence checks out, then you can plan your entry. A much safer way to do this is to wait for the price to pull back and retest the breakout level. Or, hey, if you see all the signs of a trap, you can even plan to trade the failure itself.
Now, for the final, and I would argue the most important piece of this whole puzzle, your own psychology. Because all the technical analysis in the world means absolutely nothing if your own emotions, like greed and fear of missing out, lead you right into the very trap you just spent all this time identifying.
So let's establish 3 hard and fast rules to live by. Rule number 1, never, ever, ever enter a trade on a candle that is still forming. Always wait for it to close. This one simple act of discipline will kill your FOMO and save you from countless painful losses. Rule number 2, completely shift your mindset. Instead of asking yourself, where should I buy? Start asking, where are other traders about to get trapped? This changes your entire perspective of the chart. And rule number 3, keep an emotional journal. Don't just track your wins and losses. Write down how you felt when you took a trade. Understanding what triggers you emotionally is the secret to mastering your trading psychology.
So just remember this, fake breakouts are not random events. They are sophisticated traps, but they are not invisible. They leave behind very clear clues in the price, in the volume, and in the momentum. You now have the detective's toolkit. So the next time you see that tempting breakout, you have a choice. Are you going to follow the crowd right into the trap, or are you going to follow the clues? The choice is yours.